what we have seen with the COVID-19 trajectory is the moment you ease up on restrictions, it comes back with a vengeance. Until we have an effective vaccine, that is a 2021 story, not this year's story, we will have that narrative play out. I mean, look at Europe. Just a month ago, things seem to be going very well for Europe, and now we have surging infections in various parts of the continent and a huge amount of travel curves going on. It's certainly having a negative impact on expectations in the tourism and travel industry. Similarly, in Asia, where pockets of optimism mixed with pockets of resurgence. I mean, that narrative is not going to change, and as a result, the sort of things that has remained under pressure, travel, tourism, energy, and so on, will remain so. And because we're staying at home, we'll be ordering a lot of things online and doing a lot of Zoom calls and Skype calls, and those sectors that provide those services will keep doing well.
Certainly, we've seen virus flare-ups, unfortunately, in South Korea and Australia. The World Health Organization over the weekend, Taimur, warning that, saying, well, look, we can rein in this pandemic within the next 2 years, whether that can be seen as good news or not. So you're arguing that we might be entering a sort of holding pattern. Does that mean that we can be better positioned within the markets for a long haul, basically, now, to see ourselves through essentially the next 2 years?
Well, for the long haul, I think there are a couple of things to watch out for. I mean, one is this question, and then the market has sort of started thinking about this in the last month or so, which is, are we going to have some degree of inflation due to supply crunch? If you are going to have a protracted period of social distancing, if you're going to have a protracted period of, electronic modes of, meetings as opposed to normalized meetings, then how are we going to sort of take that away in terms of price of products that are going to be high in demand, so for example, electronics, and price of products that are not going to be in demand whatsoever, travel, for example, right? So it seems to me that on balance, the price of things that are seeing surging demand, whether it is food delivery or electronic communication delivery, there is some degree of supply crunch there, and we might see some degree of inflation out there. I mean, if you see food inflation, whether it's in China or India or the US, everywhere it's up substantially this year, in the absence of any major harvest failure or any sort of disease among the livestock world. So that's worrisome. And when we look at, say, 5 year forward inflation markers in the US, it has bottomed out and been going up for the last couple of months or so, heading toward 1.7, 1.8. So I think that's one issue to keep in mind as far as the fixed income outlook is concerned, that yes, rates are going to be low for a long time at the short end, but there is this worries about curve steepening and the long end selling off. So that's one set of issue. Second is on the sort of search for yield remaining in place for the short end of the duration, and therefore where else do we see money going into other than, say, gold or digital currencies, or for that matter, more and more into equities. So if we are going to get used to the narrative of hunkering down and remaining under COVID pressure for a couple of years, this notion that we will see a rotation away from growth to cyclical, I would be a bit careful about that.